Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com. Today, I'm going to be talking about the U.S. taxation of foreign retirement plans. This is an area that has confused many U.S. tax return preparers and many U.S. tax professionals. Hopefully, after today's conversation, you'll gain a general understanding in regards to how the U.S. taxes foreign retirement plans, and you'll basically have a better understanding on how to help your client. So, one of the issues when you're dealing with a foreign retirement plan is deductions. Typically, a foreign retirement plan does not permit a deduction of foreign source income. And let me back up there and say that keep in mind that US people are taxed on the worldwide income. So if they're contributing to a foreign pension, the United States code typically does not permit a deduction of foreign income which goes into that retirement plan. There are some exceptions to the rule. We'll go into that. For foreign purposes, there is no income tax consequence when there's a distribution or a contribution to the plan, but there is a tax consequence when money's pulled out of the plan. So you have a mismatch, so to speak, in regards to taxes being paid to one country to the other. That's a big problem when it comes time for foreign tax credits. So that is one thing to keep in mind when you're dealing with a foreign retirement plan. Now, how a foreign retirement plan is taxed and the information returns that have to be filed at the Internal Revenue Service vary greatly depending on how the plan is treated for U.S. purposes. So there's three main ways a foreign retirement plan may be taxed. First, the foreign retirement plan can be classified as a qualified retirement plan for U.S. purposes. What is a qualified retirement plan? Well, think of this as a U.S. 401k. Think of this as somebody who's contributing to a retirement plan. Maybe the employer is matching the contributions, or maybe the employer is not matching the contributions. Think of it as when money's put into the plan itself grows over a number of years and it grows tax-free. Think of this type of a plan also as if there's an early withdrawal from the plan, then you wind up having a penalty, a 10% penalty for federal tax purposes. So that's the first way a foreign retirement plan can be taxed. Now, the issue with this is that in order to have a qualified retirement plan for U.S. purposes, the plan has to be set up in the United States. So when you're dealing with a foreign retirement plan, chances are you're not going to be it's not be classified as a qualified retirement plan. I only read about one exception to this rule. I believe that the World Bank has set up a qualified retirement plan for its U.S. workers. I don't quite know how they did that, but I believe that's the one exception to the rule. So when you're dealing with a foreign retirement plan, most likely it will not be treated as a qualified retirement plan. Now, another way that a foreign retirement plan can be treated, it can be treated as a non-exempt employees trust contribution or a defined contribution plan. And this is a situation where the employer has set up a trust, a separate trust from the company, and each employer that contributes to the plan has an interest in the trust. The trust itself is taxed separately for U.S. purposes. So when you pull money out of the plan itself, it's typically taxed under Section 72. It is treated as an annuity. To complicate matters even more, it could be taxed as a discriminatory plan or a non-discriminatory plan. And this subject can get very, very complicated. So I'll try to make the taxation of a foreign retirement plan, if it's classified as a non-qualified plan, as simple as I possibly can. Typically, when you're going to see this type of a plan is where an employer is requiring, or an employer has the employee making a contribution to a plan. And the plan over a number of years grows, and then there's a distribution from the plan. For U.S. purposes, if the foreign pension is treated as a non-qualified plan or a non-exempt employee trust contribution plan, typically there is not a deduction allowed from foreign source income into the plan itself. That's the general rule. Now, if there is a mandate by the employer or under law of the foreign country that requires a contribution into the plan itself, there's an argument that can be made under the constructive receipt doctrine that the contribution to the plan itself should not be taxed in the US. But in all of the cases, if these are basically voluntary contributions, unfortunately, there's no deduction permitted for US purposes. So when the money is pulled out of the plan, the way it works is that the amounts that were contributed to the plan are not taxed again. Instead, it's taxed as an annuity. And you have to look at the IRS tables to determine how the growth in that plan itself is taxed. So if you're dealing with somebody who, say, contributed $100,000 to the plan, and let's just say the plan itself, that individual paid taxes on that contribution itself, when it's pulled back out, would not be subject to US tax. The growth of the plan itself would be taxed as annuity under Section 72. Now, when you're dealing with foreign pension plans, you're dealing a lot of times with individuals who contributed to the foreign plan, that's a non-qualified plan, before they were US people. So for purposes of determining the US tax consequences, you would also go ahead and not treat the contributions to the plan prior to them becoming US persons. So that's basically treated as capital contribution to the plan. The contributions that were made prior to them becoming US persons under either the citizenship test, the green card test, or the substantial presence test. So contributions are already taxed. Contributions that were made prior to them becoming US persons are not taxed when it's pulled out of the plan, but under Section 72, it's treated as an annuity as far as the growth goes into the plan itself. It's a little bit more complicated if you're dealing with a discriminatory situation, a discriminatory plan. What is a discriminatory plan? Well, if you're dealing with an individual who, for 2025, has earned compensation more than $160,000, or who owns more than 5% of the plan, applying code section 318. And what that is, if the individual owns more than 5% of the plan, as a result of family relationship, as a result of them owning another entity that owns part of the plan, or if they have options to purchase additional stocks in the company. All that goes into consideration when you're making a determination whether or not this individual owns an interest of more than 5% in the plan. And how is this taxed? It's taxed a little differently when you're dealing with a non-discriminatory situation. And how you would tax it is, once again, the contribution to the plan itself, unless it's required, it's not subject to a US deduction. So the foreign income that is earned as contributed to the plan is taxed in the US, even though it's contributed to the plan. And any increase in the value of the plan, you basically would have to mark to market that. So if the value of the plan goes up, that individual's interest in the plan itself, as it goes up in value for that year, has to include that in their US income. If it goes down, you do not get a deduction. Only wind up including in the US tax the increase in value is proportionate to the ownership of that employee who made a contribution to the plan. So the same rules apply, though, if there's a contribution that was made prior to the individual becoming a US person. Those contributions itself, when the money is pulled out, would be treated as return of capital. Now, where you could have an interesting situation, or maybe not so interesting if it's the client, or let's just say an individual has an interest in a foreign plan, owns more than 5% of the plan, and let's just say they own between them and relatives or through constructive ownership a significant portion of the plan. You're dealing with the taxation of a foreign trust. It is possible in that kind of situation that the IRS may take the position that the plan itself is subject to the DI and U&I tax rules. So you could wind up having a throwback interest assessed on that individual's ownership in the plan, even if it's classified as a non-qualified plan. If there's enough ownership, you could wind up having a throwback tax type of situation through the D&I and U&I rules. So that's something to keep in mind of if you're dealing with a smaller company and your client winds up owning a significant amount of shares in the plan, or should I say, owns a significant amount of shares in the company, which would basically attribute that to his ownership interest in the trust. And in this case, the trust itself would be treated as a foreign retirement plan. Now, the final way that a foreign trust can be treated for U.S. purposes would be under the grantor trust rules. So if you have a foreign retirement plan, let's just say it's an Australian superannuation fund, or a retirement plan that's set up in a foreign country that mimics that of an IRA or a SIP. This is when you basically have someone that sets up an individual retirement account in a foreign country. It's not necessarily set up by the employer, it's set up by that individual. In that case, it could be treated under the grantor trust rules. It could be treated as a foreign grantor trust. Now, an IRA in the US is fairly benign. I mean, you're able to make contributions to it. You defer the tax consequences of it until you wind up pulling the money out. Somewhat similar to SIP as well. But if you're dealing with something similar to this in the foreign country, you'd have to kind of take a look at the foreign grantor trust rules to determine how to tax that. And a foreign trust where a US person has the ability to control the trust, they have the ability to determine what type of investments go into the trust. They have the ability to determine when to pull the money out of the trust. Even if it's the case where the law of the local jurisdiction doesn't permit a distribution from the plan without a penalty, it can be classified as a grantor trust. And the significance to that is that the plan itself is taxed to the U.S. person as if they owned it directly. So if there's a contribution made to a foreign plan that is treated as a foreign grantor trust, meaning that that individual has control over the assets of the retirement account. First of all, there's no deduction for U.S. purposes. The contributions to the plan are not deductible. It's not excluded for U.S. purposes. Second, any gains in the account itself, in the retirement plan, is taxed that year. Third, which is a little bit more complicated, a lot of times these foreign pension plans that are treated as foreign grantor trusts, they tend to invest in foreign mutual funds. And when your client goes ahead and purchases foreign mutual funds through a foreign retirement plan, you're taxed under the passive foreign investment company rules, or PFIC. And what that means for U.S. tax purposes, there is no favorable capital gains rates. Any gains in account is treated as ordinary income rather than favorable capital gains rates. Second, you are subject to the throwback interest. And what that means is that, let's just say, the fund winds up selling stocks and purchasing new stocks, or paying dividends and reinvesting the dividends. That growth in that account is taxed or it's taxed as if the individual received that dividend distribution or that stock sale. And not only that, there is a interest that is applied on that gain. So the interest itself is taxed at whatever the federal rate is plus 2 additional basis points. You could wind up having a situation here where the foreign retirement plan, if it's invested into foreign mutual funds, can be taxed at a very harsh rate. I've seen, for federal purposes, these type of plans being taxed as high as 70%. And that doesn't include any applicable state income taxes. So it's quite possible under federal and state law, tax law that is, that the holder of such account could wind up being taxed on the entire gains, or even exceed the value of the account. So be mindful if you're dealing with a client that has a self-directed type of retirement account and they wind up investing it into a mutual fund. Now, what we haven't spoken about earlier is your reporting requirements. Because if you have an interest in any type of foreign retirement plan, whether it be a non-qualified plan, a qualified plan, or a grant or trust type of a plan, first of all, if the value of that plan in aggregation with all the other foreign assets, or foreign financial accounts, should I say, exceeds $10,000 in a particular year, the plan itself needs to be reported on an F bar, 114. If the plan itself exceeds $50,000, this is a sliding scale, and it's adjusted for inflation annually. The plan itself would probably also have to be reported on Form 8938. Penalties for not disclosing a foreign retirement plan on an FBAR or an 8938 start at $10,000 per year each. Then, if you're dealing with a grantor foreign trust, you're also going to have to disclose that foreign trust, that retirement plan, on a Form 3520 and on a Form 3520A. Your penalties start at $10,000 each for not filing a Form 3520 or 3520A annually, and it can go as high as 35% of the distribution or for the 3520 not being filed, and 5% for the 3520A not being filed. So those forms, if they're not filed timely, 3520, 3520A, for the foreign grantor trust, or should I say a foreign retirement account or plan that is treated for US tax purposes as a foreign grantor trust, then 3520, 3520A also must be filed. If you have a situation where you are dealing with PFIC because the plan itself contained mutual funds, Form 8621 also needs to be filed with the IRS annually. And if it is not done, then you could have a situation where you unintentionally leave open the statute of limitations for audits until that form is filed. So once again, what is a foreign pension plan that is treated as a foreign grantor trust? That is going to be your individual who sets up a individual retirement account. He makes his own contributions to the plan. Then it will most likely be treated as a foreign grantor trust for US tax purposes. Sometimes it can be a little difficult to determine whether a foreign retirement plan should be treated as a grantor trust or should be treated as a non-qualified plan. You're basically just going to have to go through the plan itself and make that determination, and start working on this as early as possible, because sometimes it can be difficult to determine the difference, but it makes a big difference for tax purposes. We've talked about how these plans are taxed. There might be, in certain circumstances, treaties available to offset these harsh income tax consequences associated with a foreign retirement plan. The treaty itself is more geared for foreign individuals rather than US individuals, and that's because most treaties contain a savings clause. And what that savings clause is it allows the IRS to act as if a treaty did not exist for US purposes. So, savings clause prevents most people from utilizing a treaty position to reduce the income tax consequences on a lot of foreign source income. Now, there are exceptions to the rule. Sometimes savings clauses allow exceptions, and one exception is for Social Security. A lot of treaties exclude Social Security from U.S. income tax purposes. One example is the U.S.-Australia Income Tax Treaty. In the U.S.-Australia Income Tax Treaty, the savings clause specifically says that it will not apply to Social Security. And the treaty itself, on another part of another article, says that foreign Social Security would not be taxed in the US. Now, a lot of us in the tax community would basically want to potentially jump on the bandwagon and say, well, isn't a foreign pension plan equivalent to Social Security? And if it's equivalent to Social Security, in that case, it should be excluded from U.S. Source income, should say it should be excluded from U.S. taxation, taking a treaty position. Unfortunately, the characterization of most foreign retirement plans do not mimic that of Social Security. They're different. So be careful if anybody goes ahead and tries to say to you that you could use a treaty and classify a foreign retirement plan as Social Security and therefore exclude it from US tax purposes. There's a very famous individual who wound up telling his clients that superannuation funds should be classified as Social Security and therefore not taxed in the U.S. That individual is prosecuted in the United States for tax evasion, and he's serving a lengthy prison term. So always be careful on the advice that you take from a tax professional telling you you can utilize a treaty to exclude the income from a foreign pension plan in the US. If someone tells you that, make sure you get something in writing from them, what their position is, what articles are they relying upon in the treaty, and what provision in the savings clause permits them to exclude the retirement plan from US taxation. Now, with that said, there are some provisions in a number of treaties that allow for some favorable tax planning in the US. And there's a number of treaties that basically exclude from US income any kind of deferral. It excludes, so let me kind of clarify this. What it does, remember what I was saying is that there's various provisions in retirement plans that require a US person to recognize income tax on an annual basis from distributions, or should I say, the growth of a pension plan. And a number of treaties will go ahead and defer that recognition of gain in the foreign retirement account. Some of these countries, or some of these treaties that permit that would be the US Belgium income tax treaty, the US Bulgaria income tax treaty, the US Canadian income tax treaty permits it. The US Iceland income tax treaty permits that. The US Malta income tax treaty permits a deferral of income that is accruing in the pension plan. The US UK treaty itself permits a deferral of income. A number of other treaties also allow a deduction for contributions that are made to a pension plan. And a lot of the treaties I mentioned earlier, not all, but a lot of them also permit you to go ahead and take a deduction for U.S. income taxes for a qualified foreign pension plan in that country. There is also something else which is important. Sometimes you have foreign individuals that come to the United States and they want to contribute to their home country plan. They might be making money in the US, so they want to go and take a deduction from US income, contribute to the foreign plan. So there is a number of treaties. One is with US and Switzerland, US and Canada, and US and Ireland. I believe also US and Sweden, US and Belgium, US and Australia, US and Germany, US and Netherlands and Italy, which allow the individual to contribute to the home country plan and take a deduction for US purposes. Now, there's time limits on that. It's not forever. Check the treaty itself and see how long that would basically allow that individual to contribute to a home country plan. But it's definitely something that if you're dealing with a client from a foreign country, and they want to contribute to their home country plan, their availability to do that. And finally, there's an interesting provision in the U.S. France income tax treaty. The US-France income tax treaty permits a deduction and permits the gain in retirement plans set up in France to avoid US taxation. And this is whether or not the proceeds are paid to US person periodically or lump sum. It is still subject to income tax in France, but at least it avoids the income tax consequences in the US. I hope that you've learned a lot from today's discussion. Whenever you're dealing with a foreign pension plan, you have to kind of have to break it down into several parts when you're analyzing it. The first part would be, are we dealing with, when are we dealing with a foreign tax credit that could potentially be used because you have a mismatch, and is there any kind of planning available to deal with that mismatch? Because keep in mind, U.S. does not permit a deduction typically into a foreign retirement plan, and typically when the money is taken out from the retirement plan, that is when it's taxed for foreign purposes, and a lot of it's not taxed for U.S. purposes. So the first thing to deal with, are you dealing with a situation like that? And is there any planning available to offset the mismatch, potential mismatch, and the double taxation? Secondly, look at the type of plan you're dealing with. Classify the type of plan that you're dealing with. If you're dealing with a non-qualified plan, make a determination whether or not you're dealing with a discriminatory plan. Then when there's a distribution from the plan, see if how much of that could be excluded from US purposes. Is there contributions if you're dealing with a non-qualified plan? Was there contributions made to the plan prior to when the individual became a US person? How much did that individual contribute to the plan? How much allocation can you make for US purposes? What's taxable, what's not taxable? And then finally, look to see if a treaty will apply. Look to see if a treaty will apply as far as the contribution to the plan, the growth in the plan, and the ultimate distribution in the plan. I hope that you found this discussion to be helpful. Please keep in mind that this conversation is not intended to be legal advice. The taxation of foreign pension plans are an incredibly difficult area of law to grasp. If you've never prepared a tax return where you reported a foreign pension plan on the return, seek help. Or if you have a interest in a foreign pension plan, seek the advice of a qualified tax professional that can advise you of the tax consequences of it, any potential tax planning that can be done, and also the reporting requirements for the IRS. Thank you.